Okay. All right. So let's go. Let's go. Let me share my screen. I am using my MacBook today, which I don't typically use. So y'all bear with me as I go through this thing. All right. So we're going to talk about technical analysis here. And let's see if I can show the whole screen. All right, good, good, good. So this week, and it says week 4, but I believe we're in week 5. I need to change that. But we're going to learn how to read the charts. And so let's jump straight into this. The goal of the training is to teach you how to read basic stock indicators and chart patterns. That's what technical analysis is all about. And so tonight we'll talk about technical analysis, and it's studying how the stock prices behave based on charts and indicators. And so let me give you the difference between fundamental and technical analysis. Fundamental is the finances or the numbers of the stock. And here's what I want to tell you about fundamentals. Fundamentals always work because if a stock keeps making more money year after year, it's going to go up. Okay. If the stock is profitable and it's running its finances the way that it should run its finances, it will continue to rise. So fundamental stocks or fundamental analysis is very, very important. Now, technical analysis is the mood of the stock market. It's the mood, how they feel about a stock. Technical analysis works in a short-term basis. So, for example, when I told you guys that the market said that Google wasn't a good company because they didn't talk anything about their AI technology, and I said that didn't make any sense because they beat all earnings and they were making money, and they were making more money than they made the previous earnings report. And I said it just didn't make sense and it wasn't fair. It was because the market can get emotional. And so the market dropped Google for a couple of weeks. But guess what Google did? It came back. You cannot deny a company that makes more money than they made the year before. You just can't deny that. So fundamental analysis is your base. If you're going to ever learn anything, learn fundamental analysis. Now, technical analysis, the way that I use it, technical analysis tells me when to get into the stock. It tells me when to get out, when to get in. That's what technical analysis will tell you. You're going to see that, okay? When you see people who are traders, and what I mean is they're trading on the stock market every day. They use technical analysis because they're trying to make money like they make money on their job. An investor like myself will hold for a long period of time. That's 1 year to forever, right? I got Microsoft stock that I bought 20 years ago. And so an investor holds stock for a long term, a trader holds stock for a short term. And so you'll have either a day trader or you have what's known as a swing trader. I don't know if I have that in my notes, so write that down. A day trader is someone that buys a stock and they're out of that stock the same day. So that stock has to move that day for them to make some money. So they're in and they're out the same day. A swing trader will buy a stock and they're in and out within a year. So I might buy a stock and next week I'm out. I might buy a stock in a month I'm out. That's known as a swing trader. Okay. So I am in between a swing trader and an investor. And that's what I teach. I kind of teach you swing trading and investing. All right. All right. Now let's talk about something called the trend. This is pretty easy to identify. The trend is your friend. Y'all write that down. The trend is your friend. And typically what you want to do is you want to follow the trend to see where the stock is actually going. Now, there are 3 types of trends. There is an uptrend. That makes sense, right? The stock is trending in an upward direction, as you can see in the arrow to the left. You have a downtrend. That means that the stock is trending lower. And then you have a sideways trend, which means that the stock is trading between two forces. It's trading between a high and a low. It's kind of going sideways. It's not going up. It's not going down. It's just kind of trading sideways. Now, you can make money in all of these different trends. You can look at trends in time frames. You can look at trends over 5 years, 1 year, 3 months, 1 day, 1 hour, etc. Here's what I want to tell you. Never go against the trend. Never think that, well, the stock ought to be dropping now, or the stock's been dropping for the last 6 months. It's got to rise now. It's time for it to rise. Never bet against the trend. If the trend says it's in a down market, it's in a down market until it reverses. Okay. If it says it's in an up market, it's in an up market until it reverses. The trend is your friend. Never go against the trend. Okay. The trend is showing you where the market is headed or where that stock is actually headed. All right. Hopefully you guys got that. Now let's talk about volume, because we talked about volume last week, but I'm going to be a little bit more specific about volume. So volume is the amount of shares that change hands over a period of time, usually a day. So you remember when we looked at Yahoo Finance, we looked at the historical volume. That means that historically, this is the volume that this stock trades at every day. And then you'll see the daily volume, okay? So there's a couple of things that we're looking at when we're looking at a stock with volume. We're looking at stock that have a lot of activity, daily volume activity, because that gives that stock liquidity. And here's what we mean by liquidity. You can get into a stock, usually a penny stock, but then you might not be able to get out of it. Liquidity means that there's enough buyers and sellers that you can trade and get in and out of that stock whenever you want to. You really want stocks with liquidity. So when you see stocks that trade large volumes every day, that should give you comfort to know that you can get in and get out of that stock relatively fast. So the higher the volume during a price move, the more significant that is. So when something happens to that stock, some news comes out, the higher and the more volume that you have, the more significance that is. And it's also a confirmation to pinpoint support and resistance. So when you start seeing a stock like Microsoft that drops to a certain level, you may see the volume start peaking because people know, hey, I need to start buying this stock right now. So you may see the volume go really, really high because a lot of people are jumping into the stock. Or for the exact opposite, you may see them dumping the stock because they think that the stock is going too high. You're going to see this a lot of the time when you see a stock that makes a major move. So let's just take in any stock. I'm going to take Microsoft since I love Microsoft and I talk about it so much. Let's say that Microsoft's at 311, which is where it was at a few weeks back, about 8 weeks ago. And then Microsoft runs from 311 to, let's just say, 350 in 2 or 3 days. So it runs hard for 2 or 3 days and it jumps up to 350. You can expect a little bit of a pullback because people are going to take some profit. So when you start looking at that volume, it's important to see what's happening with that volume, because the stock ran fast and it ran high real fast. What ends up happening is people say, I need to take some profits off the table, right? So what you will see with the stock is often it'll run high real fast, and then it'll pull back for a couple of days, and then it'll take off again. And that's just because people are taking profits off the table, okay? So you need to understand that when you see a stock that has a day that is up 10%, which is that's not normal, you can expect maybe the next day that stock's not going to go higher because people are going to start taking some profits off the table, okay? And your volume will show you that. All right. Now, there is a standard price bar, and I want to talk about this because you'll see this and you'll need to know what this means. So when the market opens, when it opens, whatever price it opens at, you see that little left stick to the left? That tells you what the price was that it opened at. Then you got the long, slender body in the middle. The top of that will tell you how high that stock went. The bottom will tell you how low the stock went. And then to the right, it will tell you what price it closed at. Okay? So that's called a standard price bar. So if you ever see that, that's what that means. If you look to the left, that tells you what price the stock opened at. The body of it, which is the stick, that tells you how high it went and how low it went that day. And then the stick to the right tells you where it closed. Now, in this case, the stock closed higher than where it opened, but it could be the exact opposite. That little right stick could be below the open. And in that case, if it's below the open, that means that the stock has closed lower than when it opened. So maybe it opened up at $100 and it closed at $99. So that stick, that closed stick, is going to be below the open, right? Hopefully there's no questions there. We'll keep on. If there are some questions, raise your hand, type it in the chat. Now, here's what most of you are going to see. This is what we see typically. It's called a candlestick. A candlestick is basically the same thing as the standard price bar. It just looks different, okay? Usually when you see the standard price bar, it's just in black and white. But with the candlestick, it could be black and white, or more commonly, red and green. So the candlestick is the same thing. If we look at the bottom of the candlestick, that's going to tell us where it closed at. The top of the candlestick is going to tell us where it opened. Now, that little string that goes up towards the top and the string in the bottom, those are called wicks. Those are wicks, okay? And so just like a candle has a wick, that wick at the top tells you exactly how high it went for the day, and the wick at the bottom tells you how low it went for the day, okay? All right? Now, when you see black, that means that it closed below, okay? When you see black, it means that it closed below. So you see where it opened. If we look at on the left, I don't know why they treat black that way, right? Black always seems to be negative, right? I don't know why folks want to do that. But anyway, it opened up, let's just say it opened up at $100. And then we see where it closed. Well, we know, because it's a black body, we know that it closed lower than what it opened. So we can look at a candlestick and we can say it opened here, but it closed down here. The opposite is true with a white candlestick. It opens from the bottom and it closes at the top. So we can see that, okay? All right. Now, in this example, you'll see that the wick, they also call that the upper shadow, but most people will call it a wick. You got the upper shadow and the lower shadow. Most people will call that the wick. All right. We're going to jump out and see some of this stuff. I just want to go through these things first. Same candlestick, except it's colored. And so a red candlestick shows the direction of the stock for that day going down. A green candlestick shows the direction of the stock going up that day. It applies the same way. As you can see, the wick or the shadow shows you the high of the day and the low of the day. Okay, those are candlesticks. All right. Now, these are candlesticks as well. Now, when you see a candlestick, the body of the candlestick tells you a lot. So I'll go back here. You see these big bodies, like that big red, that big green. That means that the stock moved well that day. And you'll see that the wick, you see the length of the wick, that means that that stock has some pressure on it. And if you see a stock like this that's red, that means that the sellers were in control. The sellers were selling, right? Or the buyers are in control. And the buyers are going to be your green, where you're going to see that they're buying, okay? And so there was a lot of movement there. Well, if we take a look at this one, the body isn't so big. So what that means is that the sellers and the buyers are pretty much in agreement that, you know, this is the price of the stock today. This is what we're willing to buy it at. This is what we're willing to sell it at. There's not a lot of pressure on the stock from either sides. So what you got to understand that there's two sides of a stock every day. There's buyers and there's sellers. And depending on who's in control, you can see that in the body of the candle. And if the candlestick's a big long body, that means that whatever color it is, if it's green, the buyers were in control that day. And if it's red, the sellers are in control that day. Okay. All right. Hopefully that makes sense. So now a doji, this is called a doji. And a doji is basically, it looks just like what it looks here. It's a very small body with maybe a long, with a long body in between, but a very, very small candlestick. Okay. And that just lets you know that the open and the close were virtually equal. Maybe it opened up at $90 and it closed at $90.50. That's where you would see a doji bar. Okay. Now, the reason why I brought that up is because there's an entire course on learning candlestick patterns. So when you see certain candlesticks and you see them operate a certain way, it can give you an indicator on which way that the stock is going to go. Is the stock about to go up? Is the stock about to go down? These patterns will sort of give you an indication of what's about to happen to the stock. And there are many, many candlestick patterns. We're not going to learn candlestick patterns here in this course because I could do a 5-week course on candlesticks all by itself. But what you need to know is the candlesticks will tell you the direction of the stock. And I like to talk about candlesticks sort of like if you've ever played video games. And I'm not a big video game person, but I've watched people play video games. And, you know, if you look at the remote control or the controller on the video game, it's square, triangle, circle, right? And so depending on what you hit, you might hit the F1 button, square, square, circle 1 to do a karate chop, right? Or circle, circle, square 2, or square, square. That's going to, you know, make them jump up and flip. And so there's different combinations on a video game to make the fighter do what you want it to do. The same is true here with candlesticks. There are different combinations of candlesticks that when you see those combinations, it's going to indicate what that stock is about to do. Okay. That's probably the simplest way for me to explain candlestick patterns is just like playing a video game and you knowing the different moves for the character on your video game. You can buy a candlestick book, and like I said, there are probably 50, 60 different combinations of candlestick patterns. All right. Again, we're not going to talk about candlesticks in this course, but again, if you want to take your knowledge to the next level, candlestick patterns would be something that I might take a look at. All right. Now, this one is important, and this one is something that we will be using. We are going to be using what's known as an SMA, or a simple moving average. And so you'll have a 200-day moving average, a 50-day moving average, a 100-day moving average. You can do a 10-day moving average. And what the moving average is, it takes the average of the last 200 prices, or the last 50 prices, or the last 100-day prices, and it averages them out. And that's where that line will be. So in this example, you see green, black, and red. And you see those lines, the red, the green, and the black. So if you look at the green, where the green is it's showing you the average of the last 200 days worth of stock prices. That's averaged it out. If you look at the black, that is the last 50 days of stock prices. And then if you look at the red, it's the last 100 days of stock prices. Now, the moving average changes every day because if I've got the last 100 stock prices, the next day, I'm going to drop off the back one and I'm going to add the new one to keep it at 100. So this changes every day. The moving average is going to change every day because we're dropping off one price and we're adding on the next. So if I'm looking at the 50-day moving average, I got 50 stock prices. As soon as the stock market closes, I'm going to drop off one stock price and add the next stock price, and that will be my new 50-day moving average. I hope that makes sense to everyone, okay? So we're taking averages. Now, here's what I want to tell you. If you want to see where the stock is going to go very, very fast and very quickly, you're going to shorten up your moving day average. So I may look at a 20-day moving average versus a 200-day moving average. The further out I look, it gives me more of a long-term view of the stock. But if I want to see what it's going to do tomorrow, if I want to kind of figure out where it's headed tomorrow, I might do a 10-day or a 20-day moving average to see where this stock is headed tomorrow. Okay. Now, these prices can cross over one another. And so let's just take a look at the black. You'll see that the black, which is a 50-day moving average, crossed over the 100. So when a short moving average crosses over a longer moving average, that is an up signal, and that is called a golden cross. Okay, so when we see where the black and the red just meet right there, the red is a longer moving average, but the short just crossed over the longer moving average. Look at what happens to the stock price. We see that stock price rise. Then the black crossed over the 200-day moving average. Again, we see that stock price kind of staying up above, but as soon as the black, which is the 50-day moving average, as soon as the short moving average crosses over the green, we start seeing the stock drop. Okay. Now, moving averages have a delay. So when it crosses over, it's probably the stock has already started probably already moving in that direction. Okay. Because there is a delay. It's not like it's exact science, but it will tell you the direction of the stock based on how the moving averages cross over each other. So a lot of times you're going to lay down a 20-day moving average and a 10-day moving average, or a 20-day moving average and a 100-day moving average. You're going to lay those down. So there's going to be two colors down there, and you're going to be looking for the crossover. Where is it crossing over? Okay. I hope that makes sense, because we're going to actually go out and look at some stocks and you're going to see that. But that's what the moving average is. Now, when a short crosses across a long going towards the top, that's called a golden cross. When it crosses down below, like what we see here, where the green and the black, where the black is coming down towards the end, that's known as a death cross. So we got a golden cross and a death cross. Okay. Now, let's continue to talk about these moving averages. I already talked about this, but a moving average with a short time frame will react much quicker to price changes than a moving average with a longer time frame. So what that means is a 20-day moving average will closely track the actual price for a trader. So if you're trading and you're a stock trader, you probably are using these 20-day moving averages. A 100-day moving average is more beneficial for a long-term trader. You're buying and holding. You want to see long-term where this stock is going. You're not trying to buy the stock today and get rid of it today. You're not trying to buy it today and get rid of it in a week. You're trying to find the best price. I want to find the best price of Microsoft. I want to buy it, and I'm going to ride this bad boy for a long time. Okay? So that's where the moving averages come in. The difference between using short and long is it depends on you as an investor. And we're going to see both in our class. Let's see, I got a chat that came in. Benita says, can you point out the crossover? Yes, let me go back and point it out. So, like right in this example, you see the green and the purple? The green is crossing over the purple. You see that? Then you see the green and the purple again, where the green is crossing down over the purple. These are our crossovers, okay? These are our crossovers. And your crossovers are important based on if it's a short crossover crossing over a long crossover. that's going to give us an indication, okay? But these are the crossovers, where the two moving averages cross. That's known as a crossover, okay? We'll see more of it as we go along tonight. All right, so we talked about the crossovers. I told you about the golden cross. That's when the short moving average crosses over or above the longer moving average. That is a signal that the trend is shifting up or the stock is going up. The death cross is when the short crosses down below a long moving average, and this signals that the trend is shifting down, okay? You're gonna see it. I'm just going over the sort of the definition right now. Now, this is the one that you really want to pay attention to, is we want to pay attention to our Bollinger Bands. And so the Bollinger Bands, to me, I always call it like the fallopian tubes or whatever, but they stretch. And you'll notice that the stock sort of bounces off the top and the bottom. So as you look at these Bollinger Bands, you can see where you'll see up here where it says sell. That's because this Bollinger Band, the stock price has hit the top of the Bollinger Band, and usually when it hits the top of the Bollinger Band, it's going to push that stock back down, okay? When it hits the bottom of the Bollinger Band, typically the stock goes up. So if you'll notice, every time it hits the top, it sort of comes down. Every time it gets down to the bottom or hits the bottom, it goes up. Now, does that mean it doesn't penetrate the top? Yeah, some cases it will. You'll see like here, it penetrated the top a little bit, but it's going to come back, right? And so we use these Bollinger Bands to sort of give us an indicator of, I know I want to buy Microsoft, but when do I buy Microsoft? And we use the Bollinger Bands to give us an indication of when to buy the stock, okay? I'm going to show you how all of that works, but I want you to understand this before we actually get into looking at the trade for real, okay? All right, so let's do this. It is now time to go out and take a look at some stocks. So let's go to finance.yahoo.com. And here's what we're going to do. We're going to go take a look at Microsoft. Because many of you are probably saying, man, when should I get into Microsoft? When should I get into Microsoft? And so we've already covered all of this information here, right? We know what the 52-week range, the high is 380. Microsoft is trading at 378, which means it's at an all-time high. So here's what I know. When I look at the Bollinger Bands, I'm going to see that the stock is probably riding across the top of the Bollinger Band, okay? I also know what the 52-week range was on the low, which is 219, okay? So it went from 219 to 380 in 1 year. That's pretty big, right? And I see today's range. So today, it went from 376, it was as low as 376, and it went as high as 380, okay? So now what does that tell me? Well, it tells me that the all-time high, the 52-week range, was 380.64. Well, guess what? It hit that today. So Microsoft is setting new highs, all right? All right, now, remember I told you we like to look at the trend. So when you look at this chart here, this is the first thing that I look at. I want to give you an idea of what I look at when I'm looking at a stock. I want to see where the trend is. So this right here is a one-day trend. I don't care about a one-day trend. A one-day trend doesn't tell me a whole lot of nothing. So the first thing I want to do is I want to look at the max. So I'm going to click on the max. Do you like that trend? Do you like that trend? Somebody type in the chat, yes or no. Do you like the trend that Microsoft is on? Yes. Okay. All right. So the trend is in an upward direction over a long period of time. All right. So this goes back to March of 1986, and you can see where the trend is. Now, I don't use that necessarily to make my decision, but this is something I look at and I go, okay, that's a pretty smooth trend. That's a pretty smooth trend. Now, they had some issues right here, which might have been the pandemic. There's some things that you can see, but this is a pretty smooth trend. So I may back it down to 5 years. And you can see that overall, the stock is headed up in an upward direction. Everybody see that? The stock is headed up in an upward direction. It's green. That means that the trend is going higher, right? In the last 5 years. And then I may look at the last 1 year, and the last 1 year is in an upward trend. So depending on how smooth this is, depends on how well the company is financially managed. Microsoft is pretty well managed. And so you'll see that it's a very, very smooth trend. I mean, it's bumpy, but not as bumpy as some of these other stocks that we might look at. Okay. So that's the first thing that I'm going to look at is I'm looking at the trend. I'm looking at the max trend. I'm looking at the 5-year trend, and I'm looking at the 1-year trend. So right now, we know that Microsoft is in an upward trend. The trend is our friend. We're not going to go against Microsoft, which means that if Microsoft's in an upward trend, it's going to continue to go into that upward trend until it changes. But right now, I'm not going to bet against Microsoft because it's in an upward trend. I'm going to follow the trend. So I expect Microsoft to go higher. All right. Now, let's go and take a look at the chart. That's going to be the next thing that we're going to look at. And so we just got a sort of a butt-naked chart right here, okay? And I'm going to show you how to set this chart up so that you can follow it, okay? So down here at the bottom, let me scroll down here at the bottom. These little red and green, this is called volume. This shows us the volume of that particular day. And you can see that this goes back as far as July 14th, or I'm sorry, May 14th. And you'll see these little D's. Throw some D's on it. These are your dividends that are being paid out, okay? So the D's will represent dividends. If you ever see an S, that represents a stock split, where they may have done a 2-for-1 or a 4-for-1 stock split. But right now, these shows D's, and these D's come out on a quarterly basis. You're going to see those D's, and we'll talk about that. Now, we don't see any candlesticks or line sticks, so we just kind of got this line. It's going up and down. We want to change that, okay? We're going to change that. So I'm going to scroll back up, and what I'm going to do, the first thing is you'll see where it says line. And hopefully you guys can see what I'm showing you here because I can't make it any bigger, I don't think. All right. And so I'm going to hit the drop down and you'll see that I have certain things that I can select. So I can select the bar. If I select the bar and we zoom in on these, that's what I told you earlier. On the left side is where it opened up. On the right side is where it closed. So you can see on this one that I'm looking at, it closed higher because on the right side, the bar is higher than the left. But then the very next day, you can see that on the left side is higher than the right. So that means that the stock was down that particular day. Does everybody see that? This is your bar chart. Now, most traders or investors are not going to be looking at the bar chart. The bar chart is really good for when you're looking in a newspaper because newspaper is not going to be colored. It's not going to have color. You're not going to have a colored newspaper, nothing like that. So if you're in a publication or something like that, they may use the bar chart there because it's a black and white paper. It's it's something that you're holding in your hand and it's not in color. So that's where the bar chart comes into play. But for most of us, we're going to be on the internet and we're going to be looking on the internet. So we don't look at this stuff with a bar chart. We'll go down to our candlesticks. So I'll drop down here. You'll see the hollow candle. That's going to be your black and white candle. And then the one that's colored in, that's going to be your colored candlesticks. So we'll go ahead and click on that. And now you see the candlesticks. Okay. So now what you're seeing is you're seeing like this big red candle right here. This means that this was a day that the sellers were in control. They pushed this stock all the way down, because we know that this stock closed down because the candlestick is red. This candlestick here that's green, we can see that it pushed real heavy that day, okay? And so we can see those types of things, all right? Then we see our dojis. Here's a doji where the stock is red, but it It's just a little small body. So that meant that there was nobody that was really in control. We see another doji. Nobody really in control here, okay? And then you can tell that the stock gapped that next day because where it closed at is not where it opened at. So that's called a gap. You see how that day the stock gapped up in price, okay? All right, so now we've got our candlesticks here, and we can see dojis, and again, there's a course on candlesticks, okay? All of these candlesticks, the last two candlesticks, the last three candlesticks, they kind of give you an indicator of what's going to happen maybe the next day or the next, couple of days, all right? But that's not what we're teaching here today. So we've got our candlestick. What we've got to do is we want to lay down some moving averages. Remember our moving averages? So the way that we do that is we come over here to our indicators. We'll click on that, and you'll see some commonly used. You'll see moving average. So I'm going to click on moving average, and we'll do a 50-day moving average. I'm going to make it black. I'm going to make the 50-day moving average black, and I'm going to click save. And so now you'll see the 50-day moving average. So over the last 50 days, if I average this stock out, I would average it out at $340.37 because I've taken the last 50 prices of the stock of the last 50 days, and I've added all those prices up and then divided it by 50, and I get $340.37. So now the moving average by itself doesn't tell me a whole lot. So now what I want to do is I want to either chart a 100-day moving average or maybe even a 200-day moving average. So let's do that. Let's go ahead and click on the indicator again. We'll do another moving average. And this time, let's do a 100-day moving average. And let's make our 100-day moving average, let's make it blue. I'm just going to make it blue. We'll hit save. And now we'll see the 100-day moving average. Okay. Now, you will notice that I'm going to zoom in here. Let me see if I can zoom in. You'll notice that the short, which is the black crosses over the blue right around November 10th, November 11th. So the short just crossed over the blue, which means that the stock should be trending in an upward direction. And if we go back and take a look at the stock, indeed, it is trending in an upward direction. Everybody see that? And in fact, if we come back even further, we can see that the black is gradually getting closer to the blue, which we can see that the stock is gradually trending in an upward direction as well. So does everybody understand how the crossover of a moving average will start to indicate and tell you the direction of where the stock is going to head in the future? And if this, depending on the angle of this, you can be very confident that it's going to increase. So for example, this short is angling up and is continuing to, once it crosses over, it doesn't look like it's going to get any closer to the blue. It looks like it's going to go wider. So that tells me that this stock potentially can continue to go higher. And that is the trend of the stock. So the trend of the stock is doing exactly what the indicators are telling me that it's going to do. All right. So I'm going to stop here because I see I got 3 chats here. Let's see what the questions are. Okay. The trend is our friend. Yes, yes, yes. Okay. So everybody see that. All I did is I put down some moving indicators. Now, the short just crossed over the long. What is this called? What is this section called? What kind of cross is this? Somebody type in the chat because I just told you guys. When the short crosses over the long, what type of cross is that? Yes, golden cross. You guys got it. So what you just witnessed was a golden cross. We just saw a golden cross here. Okay. All right. So now the next thing I want to do is I want to throw in the Bollinger Bands. Now the Bollinger Bands will make you dance, right? The bands will make you dance because you're going to learn when to sell and when to buy using the Bollinger Bands. So let's go and put our Bollinger Bands in. And so I'm going to click on indicator. I'm going to go to Bollinger Bands. And here's what I'm going to do. I want you guys to pay close attention to me. So the Bollinger Band uses a 20-day period. So the center Bollinger Band is going to be a 20-day moving average. And they do a standard deviation of 2. So the standard deviation is the top and the bottom of the Bollinger Band. Now, here's how I set my Bollinger Bands up. I set my top as red. I set my middle as yellow. And I set my bottom as green. So I got me a red light, yellow light, green light, okay? The reason why I set that way is because when the stock starts to hit the red, it's probably going to start coming back down. When the stock hits the green, that's probably when you want to buy because the stock's going to go back up, okay? And so what we can do is we can look at the history of this with the Bollinger Bands and see if that's true or not. So we're going to go ahead and click save. And now what you see is you see red and you see green and you see yellow in between. Now we know that the yellow is a 20-day moving average. We know that the black is the 50-day moving average, right? And so the black crossed below the, the yellow crossed above the black way back here. Okay, which tells us this is a signal that this stock is going higher because 20-day is shorter than 50-day. Okay, but look at this stock. Look at what it does. Now, when it hits the red, it can go outside of the red a little bit, but it ain't going farther outside of the red. And look what happens. It's starting to come back down. So this is the reason why I'm not buying at the height of a stock, an all-time high. Okay, because there's much more room for it to come down. Now, about a month ago, maybe, was it a month ago or 2 months ago? I was screaming, buy Microsoft. And let me show you why. So what I'm going to do is we're going to zoom down. And this right here is when I told people to buy Microsoft. Because Microsoft at this point was trading around 311, around in here. I said, buy Microsoft because it was at the bottom of the Bollinger Band. Microsoft's at the bottom of the Bollinger Band. Look what happens. Bam. It starts to go back to the top. But as soon as it hits here, it comes back down. And then it rolled here. It just kind of rolled that line. You guys see that. Now, what I'm going to do is I'm going to continue to go and look at more history. We're going to scroll back and look at some more history. Look at what happens every time the stock hits the top of the Bollinger Band. It starts to come down. When it gets close down here to the bottom of the Bollinger Band, it starts to go back up. Let's keep going. I'm going just looking at history here. We look at history. Microsoft's a great stock because you notice that very seldom does it hit the bottom. It rides the top a lot. So when Microsoft hits the bottom of the Bollinger Band, you better pay attention. So here's a prime example of a great buying opportunity because it hit the bottom of the Bollinger Band. When it hit the bottom of the Bollinger Band, the next day it gapped up. The next day it gapped up. So this is what you have to be on alert for. You have to watch the stock. Look at it again. I'm just going back. I'm going back in history. Every time it hits the top, look at what happens. It very seldom goes too far much out of the top. It stays within the top. When it hits the bottom, here's another example of it hitting the bottom. Boom. That bad boy takes off. You notice that Microsoft doesn't hit the bottom of the Bollinger Band that often. So a stock like Microsoft, it's a very big deal when it hits the bottom of the Bollinger Band. It's time to load up. It's time to, now it may hit the bottom of the Bollinger Band for a couple of days. Like in this case, it hit the bottom of the Bollinger Band 3 days in a row before it took off. So you got to have some cannolis. You got to have some, excuse my French here. You got to have some balls, right? When it hits the bottom and you get in, and then the next day it goes even lower, you got to believe in your stock so much that you say, I'm buying some more. Right? That's when you got the nads to really understand that this particular stock When it hits the bottom of the Bollinger Band, I need to pay attention because this is Microsoft. And remember, we already did the fundamentals on Microsoft. So we know Microsoft is a great company, one of the greatest. So whenever Microsoft has this pullback, and again, look at how many times it hits the bottom. I mean, from here, this was January 6th of 2023. The last time it hit was November 2nd of 2022. So that was almost 2.5 months before it hit the bottom of the Bollinger Band again. And then, we can go back and just look. You can just see every time it hits the top, it's going to come down. When it hits the bottom, now this one, it slid on this bottom for a minute, right? But you got to believe. You got to believe in your stock. Even if you had bought it up here, you got to believe, because if you had bought it up here, the price of the stock was $268. If you had bought it right there when it hit, and then it just kept dropping, and you would have got scared. But look at what happens. It starts to come back. Even up here, it's at 256. You still haven't made your money back. But then that bad boy hits 267. Okay, you make some money, then it dropped again, but then it took off. And when it takes off, which is, this is the reason why you want to buy long. Okay. All right. So that's Microsoft. And we can see what happens when these crosses happen as well. So we scroll down here and we can see the black and the yellow. The yellow is the 20-day moving average. The 20-day moving average crossed down on the 50-day moving average. So what kind of cross is this? The short crossed down and below the long. What kind of cross is that? Type that in if you know what kind of cross that is. Somebody said depth cross. It's called the death, like DEATH, the death cross. Okay. So that cross down below. And what does that mean? That means that we can expect the stock to drop. So when this cross down below, we typically could expect the price of the stock to drop. And so the price of the stock did drop. And remember, when you're looking at these crossovers, the movement probably has already happened. It just sort of signifies that that's what's going on. So we can see that the stock already had dropped. Okay, the stock had already dropped. In fact, it dropped way back here when we had a death cross back here. Right. So those are the types of things that you're looking at. Now, let's take a look at some other stocks. Let's take a look at Google. We'll go and take a look at Google. Now, the beautiful thing is that once I create that chart and I lay down my lines, no matter where I go, the lines are going to be laid down. So what's the first thing I want to do? Somebody tell me, what's the first thing I want to do? Let me see in my chat if you guys understand. So Orlando says, does it matter what time frame you look to buy or sell? It doesn't. It doesn't. So we want to check the trend. All right. Thank you. So the first thing I want to do is I'm going to look at the max. What's the trend? What's the trend, baby? What is my trend? Somebody tell me what the trend is. Trend is up. Somebody says the trend is your friend. Yes, it is an uptrend. Okay. So I like that, but that's all time. So I want to go to my 5-year. I got a 5-year uptrend. You see, it's in green. I got a 5-year uptrend. I'm gonna look at my 1 year, and I got a 1-year uptrend. So I like that. So that tells me that if I'm looking at this stock, I'm looking that this stock is potentially going to go higher. That's what the trend tells me, is that it's going to potentially go higher. Doesn't mean that it will, but it tells me potentially that it's going to go higher. So the next thing I want to do is I want to go to my chart. And now, because I've done my fundamentals and I believe in Google, I've done my fundamentals, I believe in Google. Well, now what I want to do is I want to figure out, when do I buy Google? When do I jump in? And so I jump in either here, which was September 27th. This is when Google hit the bottom of the Bollinger Band, and boom, look at what happened. It went up. Or maybe here. Now, this is where this is when the earnings announcement came out. Now, on this particular day, earnings came out because it dropped to 126. I remember that. Now, look at the volume. Look at the volume. Look at this red line right here down here. Look at how long that volume is. And that's when I was like, the market is being unfair to Google because the news came out that they exceeded their earnings. And I thought the market was unfair. So I jumped in at this price point. Then those that were following me, like Kyrie Dixon, he was actually following me. I jumped in and I bought Google on this day, and then I posted it on my Facebook timeline. Well, by the time he saw it, he bought Google the next day, or it was either the 26th or the 27th. So he even got it at a lower price than I did. I should have bought some more. And then it just took off. Now, we trade options on this. I've traded options on this. And so for him, he bought it here. And when it hit up here, he made over 48% on his money in less than 30 days. Okay. And so as you can see, it went below the Bollinger Band. Now, just because it went below the Bollinger Band, you got to know the story. So when it dropped below like this, I went out and did some research. I did my research. They made their earnings. They beat earnings. They did this. They did that. And I was like, this doesn't make any sense. Let me go get me some of this. This doesn't make sense. Let me get some. And then the next 2 days, it went even lower. But this is when you got to just strap down. You got to strap it down, because if you believe and you know what you're doing, it's going to bounce back. And sure enough, look at that bad boy. It just took off, right? It took off. Every time it hits the top of the Bollinger Band, it starts to pull down. Every time it hits the bottom of the Bollinger Band, it starts to pull up. So what am I saying to you? I'm saying to you, you got to find 4 or 5 stocks that you've done good fundamental analysis on. These are stocks that you believe in. These are stocks that fundamentally they're making more money every year, more than the last. Now that you understand that they're making more money than the last, you also know that every stocks don't just keep going higher. They have pullbacks. And that's what you see here. This is a pullback. This is a pullback. Stocks will have pullbacks. And so now what you're doing is you're waiting in the cut for your stock that you know is fundamentally sound. You're waiting for it to have a pullback. Does that make sense to everybody? So I'm gonna look at the numbers first. I'm gonna do my fundamentals. I'm gonna make sure that this stock is a stock that's making more money than the last year, than the last year, than the last year. We covered that in fundamental analysis. That's why I love Microsoft, because it keeps making more money every year than it did the last. That's that top line revenue growth that I talk about. And we also look at that bottom line revenue growth to make sure that we're not losing money, that we're not spending more than what we make. But we look at a stock like Microsoft, fundamentally, it meets everything that I want. Then I come here to determine when should I buy Microsoft. I ain't buying it when it's at the top, because I got a strong chance that it can pull back on me. But when it starts getting down to that bottom of the Bollinger Band, and with Microsoft, I know that I'm gonna have to wait 3, 4, maybe even 5 months. So here I am watching a stock for 5 months, but I'm a sniper. I'm not in and out of the stock every day. I set my target and boom, I'm done. So somebody would say, well, June, what's your target for Google? When would you buy Google? Well, you see right down here at the bottom, it tells me 124.92. So right now, if you ask me at what price would I buy Google, if Google dropped down to 124.92, 125, I'm going to purchase. Until then, I'm just going to watch it. Does everybody see that, right? So if I go back to Microsoft and I look at Microsoft, when would I buy Microsoft? A lot of people say, should I buy Microsoft right now? And the answer is no, I would not buy Microsoft right now. And the reason why I wouldn't buy Microsoft right now is because it's riding too close to the top of the Bollinger Band. If somebody asks me at what price would I buy Microsoft, I come down here to the bottom and I see that the bottom of the Bollinger Band, which is green, you see that little green symbol over here? It tells me $337.85. So guess what? When Microsoft comes down to 337 or maybe 338, I'll buy a little bit above it, but when it gets down to about 338, I'm gonna buy it. So I'm waiting for another pullback from Microsoft to come down to 338. Now, this number is going to change every day. This number is going to change every day. But I know approximately where my buying zone is. And if I didn't want to hold the stock long term, I probably know where my selling zone is, right? My selling zone is around 389.17 right now. So if I'm looking for a place to get rid of Microsoft, I'm gonna get rid of Microsoft on the top of this Bollinger Band. I hope you guys are having some aha moments. Boom. Let's go. Let's go. Yes, preach. I see it. Patience is one of the keys. Who just said that? Robert. That's really what it is. It's just patience. See, all this nonsense that people tell you, man, I'm in the market today, I'm snatching money. That's a lie. You gotta sit in the cut. You gotta sit in the bushes. You got your scope. Your scope is on target, and you just waiting for the right kill. One shot, one kill. That's me. I'm one shot, one kill. But when I shoot you, oh my goodness, it's dead on when I shoot you. So now you understand that this thing ain't that hard. Once you kind of learn what's going on, you learn how to do the fundamentals. You want to do the fundamentals because that's going to tell you what a good company is. You want to do the fundamentals. But once you do the fundamentals and you understand the fundamentals and you got 5, maybe 6 stocks that are good fundamentally, now what you're going to do is you're going to go and look at the charts for all 5 or 6 stocks. And you're going to say, okay, if Microsoft drops down to, what is this, 337. So I may say, send me an alert because I don't want to wait till Microsoft gets to 337. I may say, send me an alert when Microsoft gets to 340 or maybe 342. So you can set an alert on your brokerage account, and it will text you or email you, hey, Microsoft just hit 340. So now I'm like, okay, now I'm paying real close attention to Microsoft because it's getting close to my target zone. Does that make sense to everybody? So you can set your target zone so that it will notify you in advance as it's approaching. I don't want to wait till it gets there because I want to be in the bushes waiting. Okay. Now, Carrie says, I'm still a bit torn on whether to hold a good stock long-term or sell and take profit on the same stock when you see trends or just repeat over time. Seems like the latter would allow me to make more profit and avoid dips. Okay, great comment. So Carrie, here's a couple of things that you got to determine. So let's just say that you bought Microsoft down here in October. You bought it down here in October, and now it's way up here, and it's November. It's only 30 days. You made some money. Do I sell? You could sell, and you could make profit. But what you're not taking into consideration, Carrie, is something called capital gains taxes. See, when you got capital gains taxes, you either got short-term capital gains or long-term capital gains. That means that if you buy a stock and sell it in less than 365 days, if you get rid of that stock in less than 365 days, you're going to pay the normal tax rate that you would pay on like your job. But if you hold it 1 year and 1 day, that's 366 days, as Ms. Wanda just pointed out. If you hold it 1 year and 1 day, you can pay as less as 0% capital gains taxes, as much as capped out no more than 15%. So see, you don't want taxes to eat away at your profits either. So that's something that you want to, keep your eye on. Now, like Barbara just said, unless it's in an IRA account. Now, if it's in an IRA account and I trade in my IRA account, I don't worry about capital gains taxes because I already got the tax blanket around my IRA. Okay. So hopefully that makes a lot of sense to you. You got to be careful on that. Plus, is the stock paying dividends? Do you want to pick up dividends long term? Do you because see, for me, I bought Microsoft. I started buying Microsoft when it was $18, $19 a share. Well, we're looking at it now, we're looking at 378. I was buying it since it was $18 a share. How would I feel if I had bought it at $18 a share and it went to $30 and I'm like, "Ooh, man, let me cash out." And now look at it, it's $380, right? So you gotta figure out who you are. So for me, trading is not my income. This is not how I pay my mortgage. This is not how I pay my bills. Trading is long term, so that when I'm done working a job, I'm done, right? And I have enough knowledge that when I'm done working, as long as the Lord keeps my fingers like this, where I can do this, and I don't have no arthritis in the fingers, and as long as I can see pretty good, even if I got to go get me a big screen monitor, I can make money because I can sit here and I can just wait. Boom, let me buy. Boom, let me sell if I need some money. Now, a lot of people do that. So for me, I've got a retirement account, my IRA, where I trade in that. And then I have a regular E-Trade account that I call my play money. And this is where I'm buying and selling. I'm buying and selling, right? Maybe I need something. You guys know I just got my truck painted and all that. Maybe I want some money so I can get my truck painted, or I need to get some rims on the truck. So I'll go out to my play account and I'll buy and sell something short term for the money to go take care of something I want to buy. And there's nothing wrong with that. But I keep both of my accounts separate. So I know one account I do that in. The other account is just me. If I buy and sell, I'm accumulating and I'm buying more, selling, buying more, selling, buying more, selling. And in fact, sometimes what I'll do is I'll take options because options give me a lot of leverage. I'll take options, make money with options, take the money I make with options, and then buy the same stock. So I may do an options trade with Microsoft. I make 100% profit on that options trade. I'll take half of the profit, buy another option, take the other half of the profit, buy Microsoft stock. Mario says I'm lost now. Okay, let me stop talking then. Let me go back. Okay. So let's do this. We want to just worry about the Bollinger Bands. I got a little excited. Let's just focus on the Bollinger Bands. So Mario, do you understand how when the stock gets the top of the Bollinger Band, it is probably not the best time to buy because there's a greater chance of the stock pulling back than it is going higher. Now, in this case, we see Microsoft in this case, like if you can see where my mouse is, we see that it's above the Bollinger Band. So most people say don't buy. But guess what? Microsoft's such a great stock that it continued to go higher and higher, even as it rode the red line here, and eventually it came back under. But if you had bought Microsoft here and it was already above the Bollinger Band, you still would have made money. But there's a far greater chance that it would have come back than it was going higher. But it did go higher. So it's not a 100% guarantee that once it hits the top of the Bollinger Band that it's going to come back. But if you go back and look historically, when it hits the top, it comes down. When it hits the bottom, it goes up. And so that gives us the area for us to buy or sell. So if you're going to sell, I'm going to be selling when it hits the top of this thing. Or maybe even it hits the top and comes off of it a little bit. Maybe I sell right there. Okay. When it hits the bottom, I'm going to buy. Well, does it mean that when it hits the bottom, it's automatically going to go up? No, we've seen a couple of cases where it hit the bottom and it kept riding the bottom for a little while. So you got to be patient. Okay. but that is what you're looking for. Okay. Is that a setup? Would that setup be good for a day trader? Probably not. Day trading, I mean, so what we're looking at, this candlestick that we're looking at, this is for the day. This is a 1 day. Every candlestick that you see here, you see how the interval says 1 day? That's a 1 day candlestick. Now, if I change the interval, this whole chart's going to look different. So if I change it from 1 day to most day traders are going to be looking at it on a 5-minute basis. If I change this, and I will, it's going to look totally different. So we're going to go to 5 minutes. Look at that. It went the exact opposite. You guys see that? It just flipped itself. The exact opposite for a day trader. Okay? Exact opposite for a day trader. I don't like day trading, but I guess you could use this for day trading because I mean, if you look, it hit the bottom here and then it popped back up. So I guess, yeah, it could work for a day trader as well. But I'm going to go back to the 1 day interval. And you see that it's totally different when you look at it for the day. Okay. So I don't teach day trading. That's not my specialty. That's not where I've made a lot of my money. I've made most of my money doing this, what you see here, because I love safety and safety is important to me. Now, just like we're doing 1 day, you could even do 1 week. You come here and do 1 week, the chart's going to totally look different. So now each one of these candlesticks represent a whole week. They represent an entire week. Each one of those candlesticks represent an entire week. I like to work off of 1 day. Okay. But you can do 1 week, 1 month. If we do 1 month, that each one of those candlesticks represents 1 month. Okay. And then if you do 1 year, each one of those represent 1 year. Right. And so what you can see is year over year, Microsoft been making more money. Boom, boom, more, more, more. It went down a little bit. Boom. Like this is big right here. This is huge because of AI, in my opinion, AI, right? So then you see dividends down here. These are your dividends, right? And you want your dividends to grow. So if I'm looking year over year, in 2014, the dividends was 28 cents. In 2015, the dividend was 31 cents. In 2016, the dividend was 36 cents. So you can see that the dividends are getting larger and larger over time. And then you got some S's over here. This is a stock split. This is a 2-for-1 stock split in 1999. Okay. You'll notice that the last time the stock split was in 1999. So if you had 1 share of Google in 1999 and it did a stock split, a 2-for-1, now you got 2 shares of, I'm sorry, this is Microsoft. You got 2 shares of that stock. Okay. All right. Ms. Bonita says, money made by being patient and safe. Yes, especially for the majority of us that's probably on this call. We're probably probably the youngest person on this call is probably in your 40s. So we can't take those types of risks, right? You're too close to retirement to take those types of risks. You can make a lot of money just being safe and patient. Just be safe and patient. Let the young fellas get out there and the young fellas and young gals get out there and chase that day-to-day stuff. We're gonna sit in the cut and we gonna shoot the kill. Right? We're gonna shoot the kill. Miss Barbara says, do I have to have a Yahoo Finance account to get the charts to set up? You don't have to have an account. I would definitely recommend you getting an account like Yahoo Finance, but this could work with many other trading accounts. I just like Yahoo because it's free and it's just easy. So everything that you just saw me do, I mean, it's just easy. All right. So let me do this real quick. I'm over here and I got another laptop here and I got to make sure. All right. All right, cool. Um, I'm running two Zoom meetings at the same time. I got another Zoom meeting for my job. So Wanda says, do you still like Jeppy? Absolutely. Still love it. Still love it. So here's the thing. When I do my research and I buy something, I'm buying it for long term. So if I buy Microsoft stock and I believe in Microsoft and I do, I buy it long term and I don't worry about when it pulls back a little bit because I already know that a stock just can't keep going higher and higher and higher and higher. There has to be pullbacks. And then once there's pullbacks, then it takes off again. And then when the stock gets to a price that is ridiculous, then they'll do a stock split. So again, this is why this class that you're in, it's about trading for the long term. It's about being more of an investor than a trader. Now, what I am showing you, I'm showing you some skills that will allow you to be a swing trader, which means that you buy stock and then maybe you sell it a month from now, 2 months from now, 6 months down the road. That's a swing trade. And there's nothing wrong with a swing trade. But again, remember short-term capital gains versus long-term capital gains. Long-term capital gains, you can pay anywhere from 0% taxes on it to a maximum of 15% taxes on it, right? So when people say, well, how do wealthy people pay no taxes? It's because they don't earn their income the way that you earn yours. They're getting their income from stocks. They're doing long-term capital gains. They got a business. They're doing all of those types of things, those strategies that keep them from paying the high tax rate. It keeps them from having to pay a lot of taxes. Okay. All right. Melissa says, I think I have a learning disability when we get to Bollinger Bands and candlesticks. Okay, not a problem. I mean, here's what I would say. Just continue to, watch what we're doing with our Bollinger Bands and go back and watch this replay. The Bollinger Bands, you've got, like I said, a fallopian tube, right? And then you'll see that sometimes the Bollinger Band constricts. So you'll see where it gets, and what I mean by constricting is the bands get really close. The top and the bottom get real close. And when it constricts that way, whenever they break out, they're going to break out good to the top or good to the bottom. So in this case, we see it constricting right here. And as soon as that breakout occurs, bam, it broke out towards the top. Okay. So you also have to look at that. So if we go back and look at constriction. So right here, it constricted. It's going to break out. It broke out to the top and then it pulled back down to the bottom. If we go back and look again, look for another constriction point. I mean, there's a couple of them. You can see constriction near and it breaks out. I'm looking for a real deep where it constricts really big. Microsoft is just such a great company. You don't necessarily always see that. But when it constricts, you can expect it to break out either to the top or to the bottom when it's finishes constricting. So this is a constriction right here where the top and the bottom start to get really close. And when they start to get really close, there's going to be a breakout whenever it breaks out. We don't know where it's going to break out to, but in this case, if you use all your indicators, in this case is breaking out to the top. Melissa said, I didn't do well in biology either. So the fallopian. All right. That's funny. That's funny. All right. So that's what I have for you guys this week. This week is what I wanted you to understand is the moving averages. So you got to lay down your moving averages so you know the direction of the stock. I wanted you to see the Bollinger Band because the Bollinger Band is my go-to. I mean, once I do the fundamental analysis, I lay down this right here, I'm pretty much good, right? I'm pretty much good. And because I've selected a good stock, Microsoft, Apple, Google, Nvidia, the Magnificent Seven, whoever put down the Magnificent Seven. Those are like the 7 stocks that I'm going to look at. And I'm going to set the chart on those. And then I'm just going to sit back in the cut. Let's take a look at another stock. I've never bought this, but I do like this stock. It's called Costco. If you've ever been to Costco, man, Costco is crazy. So Costco is trading at $594. The 52-week range is $599. So that tells you that Costco is trading at its all-time high. That also tells, or close to its all-time high. Um, matter of fact, it hit its all-time high today. See how today's range was $599.94, and the 52-week range, the top is $599.94. So today, Costco hit its top range. See how we can just, when you look at stuff, it's easy to see it once you know what you're looking at. Okay. And so I'm gonna look at the trend, go to the max here, bam. Another chart that looks almost like Microsoft. If you ever been to Costco on a Saturday or a Sunday, you Costco gas, you think they're selling crack at the gas pump. Costco is just as bad as Chick-fil-A when you go to get gas. I don't know about anybody else, but Costco is that way. Costco is another great company. Now, I want to tell you this. Anytime I see a trend like this, I already know the fundamentals are a beast. You can't have a trend looking like this if your fundamentals aren't together. So I already know that they're making money fist over fist. So here's the 5-year trend. Costco got probably a prettier trend than even Microsoft at this point. Here's a 1-year trend. Costco is a beast. So now I'm going to go to the chart. We're going to look at the chart here. And look what I told you. Every time it hits the bottom, boom, 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 bam, goes back to the top. Hits the top, it comes back down, right? Now, we know that it's close to the top. So I don't know if I'd be waiting on this. I should have bought some Costco right down here in October because it hit the bottom. It went through a constriction here. You can see where it's constricting. And then it broke out. In this case, it broke out towards the bottom. See how it's constricted right here? And then when it breaks out, it broke out towards the bottom. And then it bounced up and went to the top, right? Look at Costco. Now, here's the other thing. If you look at the overall trend of if you look at the overall trend, hold on one second. Let me get this guy set up. Give me 1 second. Mr. Pettiford, I have made you co-host, sir. All right, Mr. Pettiford, you are on mute, but I got you as co-host, and I'm gonna let you take it from here. All right. I can't hear you, John. Let's do a mic check real quick before I let you go. Let me do a mic check with you. I cannot hear you. Let me just make sure that it's not me. If we got some folks on the call, can you hear Mr. Pettiford? I just want to make sure that the mic check is working. Yeah, John, I cannot hear you. So that's not good. Turn on your camera real quick and, oh, okay. He jumped out and I guess he'll be back on. All right, ladies and gentlemen, we'll be back with you here momentarily. All right. So as you can see, the trend, even with the, give me 1 second. All right, John, can you hear me? I cannot hear you. If you're in the chat, if you can hear John Pettiford, just type a yes. And if you can't hear him, type a no. I got 3 other people here in the chat or in the Zoom. If you can hear him, type yes or no. All right, John, I'm about to end my call, my other call over here, and I'm gonna jump back over here and we'll figure this thing out. Give me a couple of seconds. Okay, gotcha. Give me a couple seconds and I'll be right over there. All right, so we can see that the trend um, for the Bollinger Band is in an upward trend. So even though the Bollinger Band is going up and down, we can see that it's going higher up and down. Everybody see that? So we're in an uptrend. All right, let's see if there's any questions before I let you go here tonight. All right. All right, ladies and gentlemen, we're going to close out this call. I got to jump on this other call. We got some things going on, but the replay will be available tomorrow, and you'll get that. And until next Monday, God bless, take care, and good night, everyone.